Good morning from our global headquarters in New York. I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda. More tariffs coming soon. The Trump administration initiates probes on pharma and chips. But a possible break for autos. President Trump considers pausing his carmaker tariff, giving them more time to set up in the U.S. And a trader's paradise, Citi and Bank of America report results as the big banks bring in a record haul for equity trading. Well, you've got your first back-to-back gains for equities since Liberation Day. You're looking at adding some weight to that for the S&P 500 futures index, up 0.1%. NASDAQ 100, that outperforms up 1/3%. Russell 2000 futures struggling to hold on to any gains. Sentiment may be getting a positive boost from relief for the automakers, but more tariffs are coming. Meanwhile, there's also stability in the Treasury market. This morning, you're looking at little change for the front end of the curve, getting a boost from Chris Waller yesterday, the Fed governor, speaking about the idea of front-loading rate cuts, and inflation being a one-time off. Meanwhile, your 10-year yield down 2 basis points, your 30-year yield down 2 basis points as well. Your 10-year trading at 4.35. Let's get underneath the surface and look at some stocks to watch with this morning. Here with that is Bloomberg's Joe Easton. Good morning, Joe.
Morning, Danny. So Boeing shares dropping in the pre-market as China tells its airlines to stop taking deliveries of Boeing jets in a retaliation following Trump's 145% tariff on Chinese goods, though we can see Boeing down around 2.7% in the pre-market this morning. And I'm also looking at autos, despite that positive news on potential reprieve for the sector. Barclays today downgrading the sector to negative, saying the risks from tariffs is not yet priced in on either a supply or a demand basis. And they cut General Motors this morning, so we can see that one falling 1.1%. And then over in chips, we've got a deal falling through on semis purchase of Allegro, no longer going to take place because the companies haven't been able to agree on a final price. We can see that stock absolutely slammed in the pre-market, down around 12% for Allegro. And as usual, all of these moves and more available on the before the bell opening wrap on the terminal at the moment. Danny.
A tough environment for deal making, Joe. Great work as always, Bloomberg's Joe Easton. And in just a few moments, we're going to be catching up with Laura Cooper of Nuveen. Later in the hour, we'll be speaking with Amy Wu Silverman of RBC Capital Markets and Stephen Biggar of Argus Research on the big bank earnings, conversations you do not want to miss. Now, when it comes to sentiment in this equity market, Bank of America's Global Fund Manager survey says a record number of global investors intend to cut their holdings of U.S. equities. It also shows the largest 2-month drop in equity allocation ever. Joining us now is Laura Cooper, Global Investment Strategist and Head of Macro Credit at Nuveen. Laura, there feels to be more calm in the market today, but how do you assess where current market sentiment stands with statistics and superlatives like that?
Well, I think the current market sentiment is taking a cue from the fact that we are seeing a bit of a paring back in terms of those tariffs. But while this is incrementally kind of supporting sentiment, I think this just adds to the degree of ongoing uncertainty facing investors. We're still going to see, what is the actual end game of these tariffs that is going to continue to feed through into the confidence channel that's going to weigh on corporate profit margins. And that does suggest that risk assets are going to trade in this very choppy price action.
You see the market really hanging on to any positive news we get out of the administration. Late yesterday, it was an idea that we would get some relief for the automakers, and then it flips to this idea of more sectoral tariffs. But Laura, for the moment, we seem to be wanting to trade on the good news at a time where we still have 145% tariffs on China. How much relief can you take? Are these opportunities for dip buying?
I think there are potentially opportunities, given market volatility, to find, allocations that have been kind of hit by this indiscriminate selling. But I think market attention will now turn to the earnings season ramping up. We'll be watching for guidance coming from corporates. Are they going to be more conservative, or are they going to outright withdraw their guidance? We'll be watching for any cues on corporates' take on this ongoing trade war, kind of the evolution of recession risk, and then importantly around what the consumer demand backdrop is, because we are going to see this tariff begin to weigh more materially on the hard economic data, because as of now, it's really only hit that survey sentiment indicators.
At the same time, Laura, you have company earnings, as you said. We've started to get some hints of what we might see, but it's been extremely uneven. Walmart saying that they're going to absorb the price increases. LVMH reporting today saying that they would need to raise prices. How do you assume what margins look like? Are we about to enter a period of margin compression?
I think that probably is the case, just given the starting point has been, historically elevated margins. And I think if we look at what kind of the backdrop has been heading into this earnings season, we did see earnings revisions for the U.S. come down about 6 percentage points. But even now, they're sitting still quite elevated, just above 11%. So our expectation, as we start to see this uncertainty filter through, as we start to see the actual impact of these tariffs as they come into play, weigh on the bottom line of corporates, then we're going to see further downward revisions to earnings. And I think that provides, another potential catalyst to keep risk assets on the back foot.
There still really seems to be this idea, at least it's being talked about in a way that it hasn't been before, Laura, that we've reached peak U.S. assets and peak U.S. exceptionalism. In the Bank of America survey, 73% of respondents said that U.S. exceptionalism has peaked. You can see that in what the dollar has been doing. It's been weakening, not catastrophic levels, but that is a trend that continues. Laura, is there a sense that that narrative has peaked?
I think that is kind of a consensus take at this juncture. I think it's kind of taking a step back. The active debate is, are we seeing kind of cyclical forces at play in terms of that U.S. rotation, or is there actually more of a structural shift taking place? We have upside inflation risks in the U.S., downside growth risks on the back of tariffs. We clearly saw, the U.S. 10-year term premium in the bond market rise to quite elevated levels on the back of fiscal uncertainty. So there's that confluence of factors at play. But on a structural side, we are seeing less confidence in the U.S. dollar, less confidence in U.S. assets. And I think that is going to continue to support this rotation away from Europe, from U.S. assets into places like Europe because of that support from the fiscal impulse. But I think it's going to be this ongoing gradual rotation over time as this structural shift really comes back into, it makes more of a pronounced market move.
I think it was the Treasury market last week, along with the dollar, that really had some people frightened. Laura, I just want to play you some sound from Anne-Marie Hordern's interview with Treasury Secretary Scott Bessent when she asked him what tools he has to try to alleviate any concern in the bond market should that become necessary. Take a listen.
Well, look, the Treasury has lots of things we can do, and but again, I think we're a long way from that. But again, we have a big toolkit that we can roll out. We do regular off-the-run buybacks. We could up the buybacks if we wanted.
Of course, I just want to point out there is a little bit of irony there, considering that he had been so critical of his predecessor for using tools from the Treasury to try to manipulate the bond market. But Laura, what do you understand as the puts coming from this administration, be it a very structural one, a very technical one from Bessent, be it Trump talking down from tariffs? Just what is their threshold for being able to take some of the market pain?
I think we saw kind of the magnitude and speed of the moves in the Treasury market last week really suggest that that is where that so-called Trump put is, focusing on that 10-year bond market. I think, though, the key question is, from a Fed perspective, we're likely going to need to see a liquidity event, a significant seize in the market, more of those significant market dislocations for them to actually intervene. I think this is a backdrop where the inflation risks are tilted to the upside. There's so much uncertainty about what the growth spillovers could be from this trade policy that the Fed, I think, has the optionality to take a wait-and-see approach and really not step in to use some of their tools unless we, again, see the significant moves that we saw last week, but perhaps on a persistent basis.
That is what most Fed officials have been saying, but I gotta say, Governor Waller sounded kind of different yesterday, Laura, saying that kind of seeming like he would prefer to front-load rate cuts and that inflation would be a one-off, using the dreaded transitory. I just wonder what you make of his comments yesterday.
I think what struck me about Waller's comments yesterday was the fact that he outlined different scenarios. And that's something that we're doing at Nuveen, right? We're looking at a number of different outcomes on the tariff front and trying to create kind of a probability weighted scenario for the U.S. growth and inflation outlook. And based on that, we think core inflation this year could be, 3.5% and even higher than that. That's not a backdrop that the Fed is necessarily going to be comfortable in front-loading rate cuts if the bond market continues to show stability. It's really when we expect to see that soft data deterioration start to feed into hard data, that's when we could see the catalyst for the Fed to actually, potentially cut at that more aggressive pace that Waller is alluding to. But I don't think that is really a story. Perhaps, June, July, when the Fed meets, I think in the near term, tariffs, we don't know the impact. We don't know whether they are going to be transitory or not. So I think that's going to be the key kind of calculus in terms of the Fed thinking.
Yeah, a great quote from Savita Subramanian in Bloomberg today saying tariff modeling is a fool's errand, certainly not an easy task. Laura, thank you so much. Laura Cooper there of Nuveen. Let's get you some other top stories that are trending on the terminal this morning. China has ordered its airlines not to take any more deliveries of Boeing jets. It's the latest salvo in the expanding trade war. Sources tell Bloomberg that Beijing has also asked the carriers to halt purchases of equipment and parts from U.S. companies. President Trump's special envoy Steve Witkoff says his talks with Russia's Vladimir Putin last week were, quote, compelling. According to Witkoff, they discussed steps to end the war in Ukraine and some very compelling commercial opportunities. A check on LVMH shares. They are dropping after weaker than expected sales, down some 7%. The luxury group has been weighed down by sluggish demand for high-end goods in China and the U.S. and the threat of a trade war. Its market cap has now been overtaken by Hermes. Coming up, chips and drugs are in the crosshairs for sectoral tariffs after the U.S. initiates probes. We're going to have more on that coming up next.
I'm looking at something to help some of the car companies where they're switching to parts that were made in Canada, Mexico, and other places, and they need a little bit of time because they're going to make them here, but they need a little bit of time. So I'm talking about things like that.
President Trump there saying that he was exploring the possibility of temporary tariff exemptions on imported vehicle parts. Shares in U.S. automakers uneven this morning. We're down 1% for General Motors, more than that for Stellantis. Ford is slightly higher, of course, has a more domestic production line. For more of the latest on tariffs, we're joined by Bloomberg senior editor Bill Ferries, Craig Trudell, who leads our global autos coverage, and Bloomberg European correspondent Oliver Crook. Bill, let me just start with you because we have this threat of sectoral tariffs. Walk us through it. What might we see?
Well, we seem to have made a shift. A week ago, we were talking about those reciprocal tariffs on countries. The president now talking a lot more about sectoral tariffs. We've seen those on things like autos, on steel, on aluminum. The president has talked about them for things like lumber. Now he's ordered the Commerce Department to do an investigation that could take up to 9 months, looking at the pharmaceutical industry and semiconductor and chip manufacturing equipment that is imported in the United States. So based on the pace of things in this Trump administration, I don't think any of that will take 270 days. I expect we'd get something much sooner. And the implication from the White House is that that would result in new specific tariffs on those goods.
It's a lot of stop-start, though. And Craig, let me bring you in on this, because as we heard there, the president floating the idea that maybe there is a pause, a reprieve for automakers to bring their manufacturing into the U.S., but presumably that's something in a project that would take years to happen.
Yeah, I think, the president said several times there a little bit of time. I think, the industry would absolutely need a lot of bit of time to do some of the things that he's talking about here. And I think it's pretty remarkable, too, that, the examples that he gave of sort of onshoring or reshoring into the U.S. were from Canada and Mexico. I think, one of the things the industry has really been trying to emphasize to the president is that, North American supply chain would be, not so bad as opposed to maybe trying to sort of wean the industry off of, parts, engines, transmissions coming from outside of North America. I don't think, based on, what we hear him say on a day-to-day basis, that he's particularly receptive to those arguments. And he wants even parts coming, from over the northern and southern borders to the U.S. And that's really going to be challenging for this industry because there has been, a fair amount of progress toward North American sourcing, but in terms of bringing things over from Mexico or Canada, I think it's really hard for the industry to sort of process that when this has been a decades-long project to sort of localize and determine and define that as North America as opposed to just the U.S. specifically.
Craig, I just wonder if that's some of the skepticism we're seeing in U.S. share prices for car makers this morning. We're looking at some of the European ones that were up. You basically only have Ford and Tesla in the U.S. that are higher pre-market. Is there just a lot of skepticism that automakers can escape some sort of pain in this environment?
I think even if we see, some of the tariffs being taken off, they're going to incur expense to move this production, right? Or sort of shake up their supply chain, help their suppliers to be able to afford these shifts. And, in addition to the costs, sort of whether you do or don't do that, you also have still, let's not forget, 25%, import tariffs on vehicles that are imported. And so, this is a sort of, incremental, small bit of relief, but this is an industry that's still very much in the president's crosshairs and one that he's really fixated on in terms of how he wants to sort of reorient the way the industry has been operating.
Well, beyond sectors, we also still have country tariffs that are in the mid of negotiations. Oliver, I want to bring you in on this point because we had the EU trade rep meeting with Howard Lutnick and Jameson Greer. Was there any movement out of that meeting in terms of reaching some sort of negotiated agreement?
Yeah, so I think the Europeans are focused on basically two things, and this is due to the Trump administration's view. There's the question of tariffs, and then there's a question of non-tariff barriers. And what we got out of this readout from the conversation, we haven't got the full readout yet. I suspect we'll get that a little bit later today when Maroš Šefčovič, the EU trade rep, briefs diplomats, is on the one hand, you have this proposal from the EU. We have 0 for 0 tariffs. This is basically creating a free trade agreement between the EU and the United States on industrial goods. 0 tariffs, 0% tariffs for 0% tariffs. That is the goal from the European Union. That being said, before the Trump tariff regime, you were pretty close to equal tariffs between the EU and the United States. They're about off by about half of a percentage point, right? So it's not really going to be enough for the U.S. administration, which brings into the fray these sort of non-tariff barriers. And I think the difficulty so far for policymakers, and maybe Maroš Šefčovič got a little bit of a clue of this while he was in D.C. yesterday, is they have not been explicit about what non-tariff barriers they want to target. If you listen to Peter Navarro, as he reiterated over the weekend, they want to do value-added tax. The European policymakers, whenever you talk to them, they say this is basically a sales tax. This applies both to domestic goods and imported goods. That's off the table. But maybe you could see some progress on, say, automotive regulations. If you have the same regulations in the United States as you have in Europe, a car that's been built in Detroit could be sold in Stuttgart or anywhere in Europe without any kind of issue. That's something that the German finance minister had suggested. So these are all sort of the conversations that are beginning to evolve between the EU and the United States. However, Danny, I think it's important to point out that while on the one hand, the Europeans do want to give concessions to the United States on these non-tariff barriers, on the other, they do not want to get domestic legislation dictated to them from Washington, D.C., and that is the fine line that they've got to tread.
And it goes further than just Europe, Bill, because we are in the midst of negotiations. NEC Director Kevin Hassett yesterday saying that there are more than 10 deals where there's very, very good, amazing offers made to us. What sort of offers do we know? Do we have any details of the different nations beyond the EU that have come to the table and agreements that might be reached?
Well, we know the administration has said they think Japan is very high on the list. You had Treasury Secretary Scott Bessent down in Argentina saying that they also would be likely high on the list for some sort of deal. And the deals, what we're hearing about, can be a bit of a hodgepodge of things thrown in. So there might be a little bit of tariffs. There might be something on the non-tariff barrier front, but there also may be investments in energy projects in Alaska, things like that. So the White House is making it clear that they're willing to consider some kind of non-traditional components to these agreements, but there's no clear listing of the things they're looking for. And I think what countries coming to the U.S. want more than anything is a little bit of certainty that the deal they make, is going to be a deal that stands, that the president's not going to change his mind a few days or a few weeks later and suddenly re-add tariffs. And I think what we've seen over the last 10 days or so is a lot of the ground shifting on an almost daily basis about what is going to get tariffed, what might get a reprieve, what might get tariffed down the road. That's the kind of stability I think countries are looking for.
Well, we definitely thank you all for helping us keep track of that moving ground. Bill Ferries, Craig Trudell, and Oliver Crook, thank you so much. You're watching Bloomberg Brief. It's your Bloomberg Brief. I'm Danny Berger in New York. Let's take a look at what's on the front pages across papers this morning. The New York Times has this, that the Trump administration's move to freeze $2.2 billion in multi-year grants to Harvard after the school refused to agree to a list of government demands. Those included reforming Harvard's governance, ending diversity programs, and changing admission and hiring practices. Next up, the Wall Street Journal has this, that the president of El Salvador says that he didn't have the authority to bring back a migrant who was deported in error. This raises the legal stakes days after the Supreme Court ordered the U.S. to facilitate his return. Attorney General Pam Bondi said that it was up to El Salvador to return the person, not the U.S. Quickly on the FT, diamond traders are warning that the $82 billion industry has ground to a halt because of U.S. tariffs. Diamonds are now subject to 10% import duties on so-called retaliatory tariffs. Okay, more on these markets coming up next. From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. More tariffs coming soon. The Trump administration initiates probes on pharma and chips. But a possible break for autos. President Trump considers pausing his car maker tariffs, giving them more time to set up in the U.S. And a trader's paradise, Citi and Bank of America report results as the big banks bring in a record equity trading haul. Well, we finally got 2 days of back-to-back gains for the first time since Liberation Day. We try to add to that today. NASDAQ 100 outperforms, up 0.4%, trading the positive mood music of tariffs, a delay to autos. But we are looking at extremely negative sentiment from the most recent Bank of America survey. We'll get into that in just a moment. When it comes to this bond market, also a lot of relief there, too. You saw 10-year yields drop by 11 basis points yesterday. We are lower by about 1 basis point this morning, 4.3%. By the way, the short end seemingly outperforming yesterday after Governor Chris Waller saying that we might get something that looks like front-loading rate cuts and that inflation would be a one-off with tariffs. But we sell off this morning only by a basis point. We're higher on the front end of the curve. So when it comes to tariffs, President Trump says that chips and drugs could be next in line for sectoral tariffs. Stocks in both sectors are on the move this morning, but a lot of volatility there as we try to assess it. Auto shares also trading unevenly. GM down 1.2%, while Ford's up 0.5%. President Donald Trump said that he was exploring possible temporary tariff exemptions on imported vehicle parts.
I'm looking at something to help some of the car companies where they're switching to parts that were made in Canada, Mexico, and other places, and they need a little bit of time because they're going to make them here, but they need a little bit of time. So I'm talking about things like that.
For more, let's bring back Bloomberg senior editor Bill Ferries. Bill, great to see you again. Can you just illuminate us where we stand on sectoral tariffs to come?
Well, President Trump made some interesting comments yesterday. He said, I don't change my mind, but I'm flexible. And so he seems to be showing some of that flexibility when he talks about perhaps giving a reprieve to auto companies in terms of auto imports and auto part imports, where they source those and how long they have to produce those within the United States. But we don't have any details on that so far. What we have seen over the last week or so is really his focus going from these country-by-country tariffs to more of a sectoral focus. He's started a Commerce Department investigation into the pharmaceutical industry and the chip and chip manufacturing industry in terms of what they are importing into the U.S. That sets a 270-day clock ticking. I would expect we'd get something much sooner than that that would likely result in recommendations to the president for some sort of specific tariffs on those kind of imports.
The clock is also still ticking down when it comes to this 90-day pause for tariffs for tariffs on countries specific. NEC Director Kevin Hassett saying that they've gotten at least 10 very, very good, amazing deals, I believe were his words, Bill. Do we understand what these very, very good, amazing deals might be?
Well, and I think Peter Navarro said he's looking for 90 deals in 90 days. So we're several days into that. We know that some of the countries that the administration says are at the top of the list for an agreement, that includes places like Japan, South Korea, Argentina, where Treasury Secretary Scott Bessent was just visiting. And we know that the White House has signaled that these deals might be about a lot more than tariffs. They might have a little bit on the tariff front or the non-tariff front, but they could also include foreign governments or companies abroad investing in projects in the United States. So there's been talk about pipelines, investing in pipelines in Alaska, energy deals, and having foreign companies or governments helping invest or subsidize those. I don't think we have any kind of a cookie cutter idea of what a deal will look like. So there's going to be a lot of focus on what perhaps Japan gets in this, if they are indeed, as Bessent has said, basically at the top of the list. And Scott Bessent also saying that whoever makes the first deal is likely to get the best deal. So there's been a real scramble by countries to kind of get their negotiators in and start talking.
Bill, really appreciate your work this morning. Thank you so much. Bloomberg's Bill Ferry's there. Well, with the volatility that some of these negotiations have spurred, the latest Bank of America Global Fund Manager survey showed a record number of investors intend to cut holdings in U.S. equities. Data from them also showed the largest two-month drop in equity allocation. Amy Wu Silverman, head of derivative strategy at RBC Capital Markets, noting the same turn in sentiment, writing that the best word to describe investors is shell-shocked. Overall, I have not really seen anyone other than retail express the sentiment that it is time to buy the dip. Pleased to say that Amy joins us now. Amy, the sentiment is so bad, but I gotta say, we're now only off, 12% from the highs, only down 8% for the year. Given what you're describing and what the surveys are describing, you would think we'd be in the midst of a bear market. Is there a mismatch between what people are saying and what they're doing?
Yeah, it's a good question. And I think a little bit of it comes down to the fact that people came into this environment, overly long positioned, but they were sort of well hedged. And I think the question right now is, what does the down the road look like? What do earnings look like? A lot of investors I've spoken to these last few weeks have felt okay with the drawdowns because they were well hedged, but then those hedges got monetized. And the question from here, Danny, is do we reload those hedges, or do we think that this is the bottom? And I think a lot of investors have not come to a decision on that yet.
That's interesting. So it's a lot of sideline and waiting. So, Amy, is it earnings season, as you're laying out, that will get us to make that decision? Or is it continued headline volatility on policy? What's more important at this point?
Yeah, I think it's actually going to be this kind of intermingling between the two. I think it's going to be when management teams actually come out and investors get to ask them, hey, look, like these are the headline risks. What are you doing about it? How have you been managing your inventory? What are you going to give us in terms of guidance? I've had a lot of investors tell me, they're worried about this idea of companies just pulling guidance and they're just not sure what to model. It's almost in some cases better to have a worst case scenario than to have a question mark scenario, because then you can price in all sorts of your own tails in effect to not having that guidance. And obviously we have seen a lot of companies pull their guidance, and we're pretty early into earnings season as it is.
We are early, but the signals we've gotten so far do feel mixed, Amy. You have someone like a Walmart saying that they're not going to push prices higher because of their value-oriented customer. You have others saying that the math doesn't work and we need to, LVMH being the most recent of it. What are investors preparing for if we do get a very mixed set of results or pulled guidance? Amy, to your point, you can't really model that in. So how complicated does this earnings season get?
Yeah, it's getting very complicated, and I would say there's obviously going to be this sectoral differentiation. Some companies are going to fare better and others aren't. It just depends on their exposure to international revenue, probably in particular to China. You're kind of seeing this modeled out in the single stock volatility, and I do think that'll get more disparate. So obviously, right now we've had the financials kind of kick off earnings, and they've actually been okay, but we haven't gotten to the nitty gritty of the companies that I think the bulk of investors are starting to fear. You're going to get kind of late week 6 retail earnings, and perhaps Walmart as one of the bigger players has been okay in what they have been signaling, but not necessarily the others. And so we do see a lot of activity, again, going back to those hedges, that I think investors could reload in some of the related ETFs like an XLY, an XRT, or an XLP.
So I mean, if some of the sell-off we saw was structural to where we started, this idea that we came into the year very long, or you could even point to the Treasury market where the consensus seems to be that maybe that was more structural too, with things like the basis trade and leverage trades forcing that hand. Have we cleaned the decks, or are there still vulnerabilities in the system right now if we do get more concerns in terms of tariffs, in terms of earnings, that could reignite some of these fears?
I'd say yes, definitely. In terms of where the bones are buried, so to speak, if we continue to get these violent moves in treasuries or equity, I mean, it doesn't necessarily matter, Danny, at this point where it's coming from, but I do think that we're still not prepared for that ultra left tail, or frankly, that ultra right tail. And I think it is that worry that has caused you to have sort of this reflated volatility regime. So yes, obviously VIX has come down. And I actually thought it was super interesting yesterday during Bloomberg's interview with Scott Bessent that he actually called that the VIX spike was over. He actually said that in his interview, like as a derivative strategist, my ears perked up. But I don't know that that's necessarily the case, because we've just kind of gotten into a higher volatility regime, and we might just sit there so long as we don't know what's going to happen with negotiations as we kind of hit this pause button right now.
I think the Treasury Secretary might be coming for your job, Amy. Until then, so great to have you on. Amy Wu Silverman of RBC Capital Markets. Okay, coming up, the last of Wall Street's big banks report. Citi and Bank of America are on deck. Stephen Biggar of Argus takes us through the numbers and what he's expecting. This is Bloomberg.
Markets will likely continue to be volatile until we have further clarity. The administration's focus on trade barriers and strengthening the U.S. competitive position is commendable. At the same time, it is important to recognize that few companies have benefited more from the post-World War II economic and financial order than the U.S.
Goldman Sachs CEO David Solomon talking on volatility, which, let's be honest, has been paying off for the banks so far. Bank of America and Citi will be rounding out Wall Street bank earnings for the quarter. Shares little change for some of those banks this morning. Joining us now is Stephen Biggar, head of financial institutions research at Argus. Stephen, great to see you this morning. So the banks we've heard from so far, it is like record after record of equity haul, 12 billion altogether. What do you make of those numbers and the figures we've heard from the banks?
Yes, good morning. So the trading environment has certainly been favorable for banks in the first quarter. And it's not just for equities, which had a fantastic quarter, but of course, fixed income, currencies, commodities, that volatility has, banks have been able to take advantage of that, certainly. And probably, to continue, certainly in the early weeks of the second quarter, we're seeing more of the same. So banks do benefit, particularly when you have this major repositioning type of trades, not just kind of the steady up or the steady down as we saw for much of the first quarter. So it's, very good environment for trading.
But the concern always comes, Stephen, is it the right type of volatility, or is it the volatility that forces clients on the sidelines, especially when it comes to things like wealth businesses? What do you understand from the post-Liberation Day type of volatility? Is that still going to be benefiting the big banks?
Well, the raw trading revenues will, but yes, I think as you allude to, the street really doesn't give too much of a market multiple for trading revenues, because they are a bit fleeting and usually unsustainable at such a high level. So yes, the conversations that banks want to be having would be more the constructive type around M&A activity or IPO activity, and that is largely put on hold because of the tariff talks and companies just taking a pause and not knowing what the next quarter or two is going to bring. So, you know, the first quarter was not terribly bad on that front. We did see a little bit of activity more early in the quarter. But yeah, that definitely have hit the pause button by corporations, and just, you know, banks are not seeing the light as yet. Anyway, we still, you know, think there could be a recovery later in the year as we get more clarity on tariff and trade policy.
Because I was going to say, Stephen, I mean, the conversation is so different than where we were at the end of last year and the start of this. It was animal spirits. It was deals coming back. It was a more friendly regulatory environment. You say we need more clarity in order for deals to come back. But we've seen for the Trump administration that some of the uncertainty has really been a feature in terms of their negotiating style. Does there come a period where M&A, IPOs, we just get ahead of it? Or how necessary and what type of clarity do we need for it to happen?
Yes, well, you're right. Certainly the narrative coming into the year was much more positive. You had, you know, the notion of deregulation for the banks on a couple of fronts, and not just on the activity for M&A and maybe having an easier time to get deals approved through the Federal Trade Commission or the Justice Department approvals and the like. So there was a, you know, pretty strong head of steam coming in. That just hasn't really worked out, you know, so far anyway, because of it's been overshadowed by trade policy. So, you know, what corporates tend to need, you know, there's a combination of things that tends to kind of add to deal activity, and those are good financing terms, for example, you know, a market that's functioning well. Right now we have interest rates mostly on the upturn rather than a downturn, so that makes deals more expensive. Better stock prices. A lot of these deals are done with currency of the stock of the company. So if the stocks are down, that's also puts the deal under pressure. CEO confidence about the economy. So there's a, you know, range of things that kind of factor in, and frankly, all of which are uncertain right now or negative.
So in about an hour's time, we're going to get Bank of America earnings. About an hour after that, we'll get Citi. Stephen, what are you expecting from them this morning?
Well, we had a pretty good read-through, and the banks have been pretty consistent. J.P. Morgan, Morgan Stanley, so far, Goldman Sachs yesterday. We've had, you know, we certainly expect that great trading environment. Now, if you look at the, you know, the lending side, that's actually held up okay. We expected pretty weak loan growth with higher interest rates coming into the quarter. That's what we got. A little bit of net interest margin pressure because of the higher interest rates. I'm sorry, because of the lower interest rates coming into the quarter, but the good news is on credit quality, right? They've had very good, you know, the ability of these companies to you know, to look ahead and try to get a handle on credit costs has been noteworthy, and I think that's, you know, we're going to see more of the same for that. And I will say that, you know, some of the more recent data from the Federal Reserve on 60, 90-day delinquencies on credit cards, auto lending, areas like that have been pretty weak. So it is noteworthy that the banks are able to, you know, have a good credit cost environment. I think most have kind of built up reserves going into the quarter of, say, a 5 to 5.5% unemployment rate. We're at 4.2, so they've got a, you know, pretty decent cushion in there, and don't see that type of, you know, big slowdown. At least in the jobs picture, looking ahead a few quarters.
Well, we'll see what this morning brings. Stephen, thank you so much. Stephen Biggar, Head of Financial Institutions Research at Argus. Again, we're going to hear from Bank of America 6:45 or thereabouts a.m. New York time, and Citi comes about an hour after that. Some more earnings to work through. LVMH has lost the top spot as France's most valuable company. Hermès' market cap has now surpassed Bernard Arnault's LVMH. That comes after LVMH released disappointing first quarter results. Joining us now is Bloomberg opinion columnist Andrea Felsted. Andrea, changing of the guards, what was so disappointing at LVMH?
It was really every division missed expectations. There was no growth in each one. The impact from tariffs was pretty limited so far, but obviously it's very early days. All the interest was on the American consumer. And LVMH said that when it came to fashion and leather goods and watches and jewellery, American demand actually held up. Now, what was interesting was Sephora slowed compared to a year ago, and also wines and spirits really struggled. So those last two, beauty, cognac, they may have been impacted by tariff worries.
It's so interesting that beauty and Sephora did poorly, Andrea. I just wonder what you make of that change, because this is a segment that not just for LVMH, but across retailers had been really strong. Something changed with consumer sentiment, consumer preferences there?
There was a comparison with a year ago when it was growing very strongly. So you had a year-on-year effect. But we have seen a bit of a slowdown in the beauty market. Don't forget, beauty's been on a tear for the last 5 years. We've all bought skincare, we've all bought makeup. Hair's been a massive growth. We talk about the skinification of hair. We all put 5 products on our hair now rather than 1. When times are tough, that's just the sort of thing, people might cut back on.
Yeah, I mean, I've seen crazy videos of like hair oiling, which I don't even understand what it is. Yeah, no, it's spot on. We need like a 6-step routine for our heads now. Andrew, before we let you go, and we could talk about hair routines all day, I want to ask you about manufacturing from LVMH, because we have the CFO speaking about it, saying that there was capacity to increase manufacturing in the U.S. But of course, Andrew, these are the types of things that take years and take labor and take experts. How realistic would it be for someone like an LVMH to shift some of their manufacturing into America?
I think it's going to be quite limited. These companies, trade on their European heritage. Most of the supply chain is in Europe. Saying that, LVMH has made a go of production in the US. It's some handbags, some small leather goods. It's possible it could definitely do more of that, but there will, we'll not only have to buy the plants, it will have to train the workers, and perhaps that is the most difficult part of this, getting, employees up to speed with, sewing, construction. It's not the thing that young people want to do. So that's going to be the biggest challenge.
We're all too busy playing with our hair to learn how to sew a bag. Andrea, thank you so much. Bloomberg opinion columnist Andrea Felstead. Okay, coming up, we're going to set up the day for you. More Fed speak. And I hope you've done your taxes. It's the U.S. tax deadline. This is Bloomberg. Let's get you set up for your trading day on this Tuesday. Bank of America and Citi will be wrapping up the big bank earnings. Those numbers are out before the bell. Plus, the U.S. income tax deadline is today. And Fed Governor Lisa Cook will be speaking at 7 p.m. Eastern. Let's look at some stocks on the move pre-market. China has ordered its airlines not to take any further deliveries of Boeing jets, part of the tit-for-tat trade war. You can see the impact there. Boeing down more than 3.5%. General Motors also falling down 1.2%. Despite some relief, maybe temporary reprieve for tariffs, Barclays downgrading GM to equal weight from overweight, cutting its view on the U.S. autos industry and mobility to negative. Finally, we're looking at Citi. It is trading higher ahead of its earnings results. Pre-market up 0.7%. Will it be another bonanza when it comes to the equity traders? All right, as we head to the end of the hour, let me give you a look of overall markets, because we are looking at yields so far this morning. On your 10-year yield, little change. We did see the front end of the curve go lower by about 11 basis points after hearing from Fed Governor Christopher Waller saying that the inflation boost from tariffs would be temporary and concerns about the economy were more important. Okay, that's it for your Bloomberg Brief. Surveillance, that's ahead.